Well, thank you everyone for joining us today as we present our workshop on first-time home buyers, how to qualify and apply for a mortgage. So hopefully after this workshop, you guys will feel more confident about, what kind of things that I need to do to actually prepare myself to qualify for that loan. Today, we have two individuals, Mr. Rich Benyon and Mr. Pear and Marcus, I'm sorry, I should have asked you that before. Mr. Rich Benyon, he's retired. He was retired in December 2019 after a 42-year career in the mortgage business. He began his career in 1977 working in secondary markets, followed by 15 years as mortgage branch manager working in home loan and construction loan origination. He also served as executive vice president and residential lending director for HomeStreet Bank from 1995 through 2019. Mr. Benyon was active in many industry groups during his career, including board member and president of the Puget Sound Mortgage Lending Association and Washington Mortgage Banking Association, member of the Mortgage Banking Association of America's Residential Board of Governors, and the Mortgage Banking Association Board of Directors. Mr. Benyon has been a member of the UW Tacoma's Milgar School of Business Executive Council since 2003 and served as chair in 2018 through 2019. He and his wife, Diane, have been married for 49 years and are the parents of 3 grown children and 3 grandchildren. Thank you, Rich, for being here. And Pear is a branch manager at HomeStreet Bank. He graduated from college with a degree in business administration. He started in banking in 1998 and in the mortgage industry in 2003. He assists in the financing needs of first-time home buyers, move-up buyers, investors, and clients needing refinancing solutions. Marketing with his business partners is a big passion of his to have a win-win effect. He loves leading the fantastic team at HomeStreet Bank family that he is blessed to be a part of. Thank you for being here today. And then basically we'll just give it to you guys to kind of take it from here.
Okay. I'm going to stand up to start this. Thanks for coming. And also everybody, if there are any people on Zoom, just to introduce the topic, homeownership. I assume you're all interested in owning a home at some point. That's why you're here. And I would encourage that. But I'd like to start out with just the thought that you should think of homeownership not just as an investment. It's shelter. We all need a place to live. And it turns out in this country that over time, homes tend to appreciate. So there is an investment aspect of homeownership as well. But I don't think that should be your primary purpose. That gets people into trouble sometimes. It also isn't necessarily for everyone. You have to understand when you buy a home that it's just the first of the cost. There's maintenance, there's insurance, there's taxes, there's all kinds of things. But on balance, I mean, I've spent my career in the mortgage business. I'm a believer in it, a believer in home ownership. It's benefited me and our family. And it really is, it turns out to be really the first building block for most Americans of creating wealth and creating an estate. So I'm all for it, but you need to be prepared. And we're here today really to help you understand how to get started. And most people need a mortgage to buy a home because you don't have enough cash. Pear has been a loan originator for many years, 20 some years, and really is an expert in the mortgage process. And so we're just going to have kind of a conversation. I'll ask him questions. And in order for us to cover enough kind of topics in a limited time, I just ask you to jot down questions when you have them, and we'll allow some time at the end for Q&A. And so, Pear, start us out with, how do you start preparing to buy a home and get a mortgage?
Yeah, we kind of discuss this ahead of time too, just because I feel like the benefit of doing it at this sort of age or point in life is that it does take a moment. And because I feel like the foundation is all around credit, and then it builds to assets. And then obviously the catalyst on top of that is employment. So I feel like the starting foundation of preparing for homeownership and making it a reality is right around credit and the establishment of it if it's not there already. And that can take shape in various ways. Some actually development of credit can be through student loans and student loan repayment. But the most common one as a starting point is some sort of credit card. And that can be a retail card, it can be a traditional credit card, or if that's unable to get, it can be something as easy as going to a bank and getting a secured credit card, meaning that they take part of your savings and they go, okay, I'm just going to hold on to this. And you can have the equivalent of a limit. So $500. And then you show your ability to repay, use, repay. And then typically after about a year, they go, okay, great. Now you're going to have an unsecured credit card. And now you've established and shown credit. So those things are so vital to start early as possible, because all banks, all lenders, brokers, any aspect of that is going to want to see some sort of history. And of course, ideally a clean one. So making sure that you don't treat a credit card or anything like that as sort of a, well, I'll repay when I can repay, or it's so critical, the timing of it, of always being paid on time, even if it's a month where it's difficult to pay the whole thing off, at least pay whatever's the minimum due. So they just want to see that history. And the longer it's in effect, ideally 2+ years, the better your credit score will be. And there's also some guidelines or sense they want more than one source. So again, if that is a student loan and a credit card, great. If it's a student loan and a car loan, great. And just keeping those going, paying them on time. So they typically want to see 2 to 3+ what they call trade lines, and that's any source of credit.
How about things like cell phone?
Yep. And so that's
records and utilities and
awesome.
Or rent.
Yep, you got it. And so then sometimes and I'm glad you said that, because sometimes if you start getting towards the point of homeownership and you're, gosh, I only have one source of credit. I wasn't really able to do it, or I haven't thought about doing it. Now and then banks are able to use what's called alternative credit. And that can be your rent history, assuming the rental payment is in your name. It could be your cell phone bill. It can be a monthly paid insurance bill, like car insurance, a different type of utility, whether that's electric or anything like that. But the key is it needs to be in your name. And so sometimes what I run into with younger home buyers or straight out of college is that for so many years, that's been under a parent's name. So the sooner that can be put into an individual name, the better, because we want to see that history. So I always try to have people do a mental note. I'm like, okay, well, try to get into your name as quickly as possible, because then it's your history, not your parents' history.
You got to get off your parents' cell phone bill.
Yep.
The cell phone plan.
Yes. And as a parent, I'm hoping my children get off of mine.
Exactly. Yeah.
Yeah. No, great question. So and it's kind of categorized as such, like traditional credit cards, student loans, car loans. Non-traditional credit or alternative credit can be the proof of those different, rent, utilities, cell phone, insurance. So those are really, 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 really important. Whatever you pay monthly, we can typically get a verification from that entity and say, hey, can you give me a history of their electric bill or whatever? Those are the two things that are the building blocks of your ability to get a home loan. Sometimes your ability to get a car loan, but car loans are sometimes easier to get. Again, it just affects everything. So I always say that's the floor. Get that one figured out. And it helps you a ton in life. Also, Washington State is one of them, but there are plenty of states that their insurance is based upon credit scoring also. Washington State, I think, blocked it a few years ago.
Mhm.
But there are still some states. So if you end up moving out of state for a job and you want to get car insurance, that state may allow your insurance company to pull your credit. And so that can affect your insurance premium too. So again, not in Washington State because there's a law against it, but nationally, most insurance companies really want to use credit because it is a lead indicator for them on how they should charge your premiums, not just your driving record. So anyway, just food for thought on that side of things too.
How about credit scores? And like, what can you say about a minimum?
Yeah.
How do they work?
Yep.
I wouldn't get too far into the weeds. And how do you find out what your credit score is?
Yeah. So credit scoring is an odd deal. FICO, Fair Isaac Company, kind of takes from, there's three main credit bureaus in this country, TransUnion, Equifax, Experian, that seem to own all the data. And it's a bit of a, what do you call it? Oligopoly. I think if I'm, so they have where just you have a limited number of entities really controlling the entire market, and they are for profits. And so they're the ones that track all this data, all your credit card usage and everything like that, all the credit card companies. And some don't report to all three of them, but most do. And so your goal is to always get as far into the 700s and above for that. But the slight tricky part is if you go to Credit Karma or if you try to track your credit score, those type of entities are just trying to use a guesstimate algorithm because FICO, also a for-profit, they're the ones that own that proprietary data that still most mortgage companies utilize. There is legislation to try to get away from that model because, again, it seems to be too controlled. And it seems to not factor into these alternative credits. Hey, but they have a great rental history. They have a great this history. Why doesn't that get to affect it? So this may be become a dated thing, which is fine. But yeah, you want to try to get into the 700s. And again, it's doing is tracking an algorithm of your payment history on time, how what your balance on a credit card is versus its limit. So it really wants your balance to be at 20% or less of its limit. Those kind of things is what it tracks. And the biggest thing too is, trying not to close credit. I have some clients that think that, or have been told, and this is old stuff that doesn't apply anymore, that in order to get ready, I should close whatever credit cards I don't use. So I'm like, never do that. Always leave them open. Doesn't matter if you haven't used them, whatever, too, because you're kind of getting rid of a history. So don't do that. But yeah, trying to get, the higher the credit score is, the better pricing you get on a mortgage. It's just sort of simple methodology when it comes to that.
At this stage, I wouldn't get too hung up on that. If you pay your bills on time, chances are your credit's going to be okay and sufficient for a mortgage. Think of it this way, sort of at a high level. When you go to a lender, a bank or a mortgage company or what have you, to apply for a mortgage, the lender is making a determination of how likely is it that we're going to get paid back. And so they're looking at the borrower, you, and your credit, your income, your employment history and whatnot. That's the credit side. And on the collateral side, they look at the house and see if it's worth in the extension of whatever amount of credit you're applying for. And that's a whole different thing. We're talking about credit here. So so just pay your bills on time, go to the university, get an education, get a job. You're doing the right things.
Yep. And don't get, and try not to get tempted with credit card offers. I mean, that's because they want to look at that history. And if you keep having new history and they're like, oh, and because, anyway, so try to be consistent with the credit card you use. And sometimes don't worry about the interest rate, because if your whole goal is to just pay it off every month, that interest rate does not affect you.
It doesn't apply to you. Right. So Per, what are the big stumbling blocks with the challenges to get into your first home? Say, my credit's good. What do I need now?
Yeah. So the next step, I feel like in the realm of what's needed is down payment, or your assets, your ability to save. And so again, this is where it's so important to establish some sort of good banking relationship, on the checking and savings side. And then if you do some investing, fantastic. But it's really trying to come up with your own down payment. There are plenty of programs that use down payment assistance, grants, and those kind of things. And those are fantastic, and they're available, especially for first-time home buyer. They're really income sensitive. And we'll talk about income and employment here a little bit later, but they're income sensitive. So if you land a killer first job and you're like, oh, I make X, Y, Z, you're like, well, you don't qualify for these down payment assistance programs. You make too much money. You'd think that would be a sort of a luxury problem. But so the earlier you can start having some savings, the better, because the programs that allow for these grants and down payment tend to have slightly higher rates. So they're able to get them, and they're great because you can come into a home buying situation where you don't come up with any of your own down payment, but it usually comes at a slight price. Not always, but sometimes. But if you can save, ideally 3+% of whatever you're buying, so $3,000 per 100,000 in purchase price, if you can have the ability to save that and have that ready by the time you buy, that's fantastic. Then you get into normal programs with normal pricing structure. And the bank really looks at that, and they go, okay, great, you're trying to buy a $400,000 house. Do you have $12,000 between checking and savings? And they also allow for, so you have down payment assistance programs, like the one that's big one here in Washington State is Washington State Housing Finance Commission. But then the city of Tacoma, Pierce County, Lakewood. So a lot of times each municipality will also have some sort of program. And those tend to be even more restrictive on incomes because they really want to help low-income borrowers do that. But the programs also allow, if you're fortunate enough to either have a parent or grandparent or relative that wants to help with home buying, they go, hey, we've set aside $20,000 and you can use that to buy a house. And that's totally allowed. And in fact, very favorably looked at. So gift from family, oddly enough, it's family, employer, or church. Those are the three valid sources of gifts. So I don't know if that's just an old rule that just has never changed, but those three entities or three buckets you can get gifts from. It's very rare that you see it from a church, and rather rare from an employer, super duper common from family. So establishing that and having a pattern of like great, I need to like per paycheck, try to put some money away. And that should be for everything anyway, like a rainy day. That doesn't even have to be for home ownership, but just having a history of that, because my always fear when I talk to, especially first time home buyer and sometimes subsequent buyers is, hey, you're paying rent at $2,000 a month. You're wanting to get a mortgage for $3,000 a month. So you're $1,000 more a month, but you haven't shown the ability to save even at $2,000 a month. So how are you going to suddenly afford $1,000 more a month? So it's, yes, bank can maybe qualify you, but just think about it yourself. I'm a big believer in sort of household cash flow. So you should already have an ability to save, in my mind. So I think again, and that could be through retirement accounts, sometimes regular investment accounts, brokerage accounts, and then traditional just bank accounts, checking, savings, anything like that.
Back to kind of the broad picture of lending. The lender's going to look at your credit, going to look at the amount of credit that's going to be extended as a percent of the value of the collateral. And like Per said, unless you're a veteran and you are eligible for a VA loan, which is a zero down payment, typically I think still the smallest down payment is 3%.
Yep.
More common is, I think, 5%. And then of course, the more you put down, the better from the lender's point of view, because it lowers the risk. So they're going to look at those two things, and they're going to look at your capacity to save. Has there been a pattern of savings? And that's pretty easy to see from your savings or checking account, your banking relationships. I would encourage you to establish those if you haven't already. And then they look at employment history, because you're looking at a long-term commitment, and what is this person's capacity to manage their finances? That's accumulate savings, pay bills on time, and so forth, and also earn a stream of income. Now, I don't know, most of you, maybe all of you, are not working full-time at this point. Maybe you're working part-time, maybe not working at all. But one of the questions on a mortgage loan application is how many years of school have you had? And so, lenders saying, oh, this person's a college graduate or what have you. And that's good, because theoretically, hopefully practically, it enhances your ability it enhances your employability and your ability to earn future income, which is what the lender is interested in. So this is a plug for your education. You're doing the right thing by getting an education. Those are the things. I remember in underwriting a loan, you're looking at a whole picture, and you're trying to get a picture of the person, and even the gifts. If you have a gift from a parent or an uncle or aunt or something, it's usually parents. It demonstrates, this is somebody who's got some support. In the event of an emergency, there's kind of a network of support, and if you have an education, that's support as well. Okay. So maybe, Per, you could kind of talk to them or say something about the process. Where do you go and how do you apply for a mortgage?
Well, I also wanted to kind of tag along with what you were talking about on the employment side. And again, they do want to see an employment history, but quite often I see college graduates that end up, you get an offer for a salaried position, and it's a good enough one to the point where you can, even that starting salary, you can afford owning or buying a house. Just know that they want to see a 2+ year history of employment, but from recent college graduates, they will go, oh, well, oh gosh, you were in school for 2 years, 3 years, 4 years, 8 years, whatever happens to be. So we can use school transcripts as part of that history. And typically they correlate, right? So if you're studying XYZ, you tend to get a job in rather the same field. I studied international business, but I ended up in banking, but oh well. But it's one of those, so that because suddenly you're like, gosh, I landed a killer job. It's got an amazing starting salary. And rather than renting anymore, I want to just buy. Then we can go, okay, great. Don't worry about it. We can use your brand new salary. We're going to look at your school transcript, and we don't judge grades. And just go, okay, we'll use that as part of a history. So just know that part of what Rich is saying about wanting to see this overall history, schooling has a huge benefit in that. Or if you just wait 2, 3, 4 years after you go to school and you're long-term into your employment, they kind of just want to see then the consistency. Like, yep, I haven't worked and then quit work for 2, 3 months to do whatever I want to and then go back to work. That they want to see some consistency and some trend inside of that. So yeah, super duper important. And then, yeah, as far as the application process that we talked about
Well,
before getting ready for it? or-
Before we get, yeah, you just reminded me of something else. How do you feel about frequent job changes? How does that?
Yeah, so the banks do not love that, because again, they want to see, and also there's the trying to predict, so just like what credit does for you, because that gives them an indicator like, okay, well, you have a history of paying things on time, so you probably will in the future. Same thing with employment. They were like, well, gosh, you seem to be switching companies every 3 to 7 months. Like, this is hard. And they're part-time jobs or they're hourly jobs, but with variable hours. How are we supposed to predict what you're going to be making? So that's the hard part from the underwriting perspective and lending, is that we want to see some sort of stability. Like, the whole premise is to take risk out of the, because we're typically giving out hundreds of thousands of dollars. So trying to take the risk out of that. So if you have a steady jobs, even if they're hourly, or if they're certainly salaried, great. But if you're with an employer for a year, you get headhunted to another employer in the same exact field of work, you go from salary to salary, not the end of the world, because that happens. You go, okay, great. My starting salary at XYZ company was 80,000. I was there a year. I did a really, really good job. I was headhunted, and now I'm making 130,000. And so then there's like, okay, well, there's logic behind that. And so then that does not negatively impact you at all, even if you were just there a year, but you just jumped straight from one to the other. So yeah, so there's the predicting aspect that's so important in underwriting.
I think, I got in the business many years ago at a time when people tended to be in a job for a long time, like I was. And that's really changed. And so, what Per said is, the lender's going to look for kind of the ability to earn income over time. And people change jobs a lot. Every 3 months is probably a little questionable, but fairly frequent job changes is not real unusual, so long as there are not big gaps, and so long as each time you demonstrate an ability to either maintain or increase the earnings. In other words, there's a reason for job changes. You went from 80 to 100 or 80 to 120 or something. If each job change, you have a decrease in pay, well, then you have to think, well, did they get fired from the last one and they can't hold a job?
Yep.
So we may be overthinking this, but we're trying to give you how a lender looks at your history. And then, of course, like we said, if you have some interruptions and it's because you're in school, that's okay.
Yeah, schooling is looked upon very positively, and for good reason.
Yeah, exactly, because it relates to the ability to generate income.
Yep.
Oh, okay. So what did I? Oh, the process itself. What is that?
Yeah. So typically, and again, and then we'll make sure that we allow time for some questions too.
Sure.
But typically, when you get to that point where you're like, gosh, okay, I have this job offer, I have been able to save up, or I'm fortunate enough to have some family that wants to support me, or I want to try to see what this looks like with the down payment assistance program. That's when you, at that point, would want to approach any kind of mortgage lender of sorts. And again, a application for a mortgage is probably the most intense application you can for any kind of credit. Credit card super easy, car loans way too easy. Should be a little bit more difficult. But it's gathering of the bank has to pull that credit report. So get your social security number, date of birth, They pull that credit report. It's like, okay, do you have credit? Do you not have credit? Is your credit good? Is the credit bad? And so they're really diving into that. And then it's like, okay, great. Let's look at your employment history, your school history. And so we start gathering like all the things we just talked about for the last 30 minutes. We put on like one application. So we gather all this data. We want a 2+ year address history. So if you moved a couple of times, just make sure you keep track of those addresses. If you've been through a few employers, we are going to ask for, if you have some W-2s, even if they're part-time jobs, while you're going to school, they kind of do want to know what those jobs were, even though those jobs may not be applicable, but they want to just hear, okay, great. I worked at Starbucks for a year while I was in school. Great, perfect. From this to this date, but you're also in school from this to this date. So any kind of W-2s you've had in the 2 years preceding when you're trying to make a loan application. So like, let's say tomorrow you're like, I'm going to go buy a house. Then we want to see all the W-2s from 2021 and 2022. So make sure you try to like hold on to those things because we do ask for them. And a lot of people cannot find them. And so then it's a little bit more of a guessing game. And then it's just a numbers game. So we typically want to see that your gross income, so your before tax income. So let's say, I'm just going to use super duper simple math. Let's say it's 100,000. Actually, I'm going to go even simpler. My apologies. 120,000, $10,000 a month. We want no more than 45% of that to go towards all monthly debt obligations. So $4,500 a month. Probably no one wants that much debt at this moment, but and that includes your car payment, student loan payment, any kind of minimum payments on credit cards, and then the new mortgage you're trying to take out. So that's kind of the super oversimplified math behind it too, as far as can you qualify for this house? So let's say you have a $500 car payment, you only have like about $100 a month and minimum payments on your credit cards. Then you're like, in the house that you're wanting to buy comes with like a $3,000 a month mortgage payment. Then, okay, great. So you have $3,600 in obligations in total. We said the maximum was going to be $4,500. Totally, go for it. So that's the overall math that they look at once you start going through this application process. And a lot of times, again, like we're like, hey, we can give you up to $4,500 in debt. You're like, whoa, I want no part of that. I want this. Then we can kind of backtrack into it and go, okay, great. If you're only comfortable with a $2,000 a month payment, what price of a house does that buy you? So at that point, we start doing reverse math into it and go, okay, great. You have 20,000 of your own funds, and then you can borrow 275,000. So great, $295,000 is your max purchase price if you want a $2,000 a month payment. So that's the nice thing is that you'll sit down with a lender and really go, hey. So actually, yeah. So I should step back and say, before you meet with a lender in the future, try to figure out your household budget of like, how much am I actually comfortable paying? And you need to be realistic that as a first-time buyer, typically it's going to be slightly higher than what you're comfortable with because house prices are high and it's a little tougher. So you shouldn't equate it to, well, I'm getting a scream of a deal. I've only paid $600 in rent. Well, that's not going to get you a house. So being really, really realistic on like, hey, at this number, I have the ability to still save and I have the ability to live my life. I can still go play, I can go travel. I have the ability to save and I have the ability to, if something comes up in emergency, to still sock away some money for that. So always like have that budget in mind. So when you meet with a lender, they can go, okay, great, perfect. Even though we came up with a higher number that we would lend you, awesome. You have your number set. Let's start talking what that affords you. So that's kind of that neat conversation that you'll go through. That's probably the more enjoyable part, trying to figure that budget out, the mortgage applications and handing over W-2s and pay stubs. And that's the less exciting part.
So Per, just what he was talking about with, the 45% of gross being the maximum amount of monthly debt you're going to service. That's called the qualifying ratios, the ratio of your debt to your income on a monthly basis. So think about it that way. So what are the common things that blow that out of the water? I mean, when you look at somebody, what are the things that often stick out as big obligations that prevent?
Well, it's interesting too, like how many buyers are, so that you don't have the thought that you're going to buy a house. And so you're like, okay, great, I need a car. I'm fine with a $900 a month car payment because I'm just paying pretty cheap rent. Well, then suddenly you're like, oh, that's going to really count very negatively towards me. Like I was able to afford that, because I have a really low rent. Well, then when you go to buy, they're like, well, that $7 rent payment is now going to be a $2,000 mortgage payment. So those are the things that usually blow things up is car loans. Student loans are a little tough because most of them are in deferral and everything like that right now. But then it's a matter of what type of repayment that you choose. So some people want to go super aggressive. I'm like, well, now you've obligated yourself at a really high number. So I always say, like, if there's not a gigantic differential in rate, choose the most comfortable payment system, or that a lot of times it's income based, but because you can always voluntarily add more to your student loan payment. But if you already say, hey, I'm going to do this super high one, then you've already told the student loan servicer that, hey, I'll pay you this high number.
Then you're obligated.
Yeah.
And
So just go with that and pay more, because there's no penalty for that. So
Right.
it's on your terms rather than the student loan servicer's terms. So those I see, and then, maxed out credit cards, pretty tough. And also that will negatively affect your credit score. So those are the things, the illogical jumping around of employers or gaps in employment, the ones that is like, okay, well, you have 7 different types of employment. Like you went and did this and this and this. And we touched super briefly on crypto. So I want to just, for a hot minute, I'm not super savvy on the world of crypto, but I am knowledgeable about the effects on lending. Crypto is so hard to trace because, and part of it, banks are regulated by the government to prevent money laundering and all these things. So we are really, really burdened in a good way to proving, is that money yours? And very little of crypto can you print out a normal looking statement that says, hey, I happen to have this many tokens, coins, whatever. There's very few databases for crypto that print that out in anything other than like an Excel spreadsheet. And if you give us an Excel spreadsheet, well, a 10-year-old could have changed those numbers. It's like, oh, that's $1 million in there. So we do not accept that. And so then clients are like, oh, well, I have $9,000 that are stuck that I want to use to buy a house. It's like, well, you need to move it from crypto into our normal bank account and let us sit there for a couple months. And then we can use it. So just know that crypto is very, very difficult. If you get paid in crypto, also very difficult. So as tempting as crypto might be, just know that it's still so new, so not regulated that banks are a bit leery of it. And then also at the moment, if you are this is the only other one that creates havoc. If you happen to be super entrepreneurial and you want to go and operate a marijuana store, that is also because it's not federally legalized. Banks are very leery of that because it's like, well, what happens if it gets like, they're like, no, never mind, this is not working. If you're an employee of one and you're a W-2 employee, that's fine. But if you're the owner of one, it's also a little tough on the lending side. So those are the 2 odd things that we're running into more now, because again, over the last 3, 4, 5 years, they're becoming more prevalent.
Those are really good points. Remember that the lender is going to want to verify income and assets. So you have to have assets that are verifiable. That's like savings and checking accounts. It's say you've got an investment account. One of my and crypto won't get you there. There may be value to it, but you just can't document it. One of my favorites was many years ago, like 35 years ago or so. And I was originating loans.
Slightly before crypto?
Slightly before crypto. Anyway, so I was going through this process with this woman who took the application. She really didn't have any cash. There wasn't enough cash to make a down payment. She didn't have much in the way of assets. And then she had on her list of assets a bracelet that she valued at, I think, $40,000. And I said, wow, nice bracelet. And remember, this is 35 years ago. And I said, well, tell me about the bracelet. And she said, well, I got it from my mom, and it was a bracelet that she went to a concert, an Elvis concert, and Elvis threw the bracelet into the crowd, supposedly, and her mom caught it. And it was like costume jewelry, you know, but she valued it at, she said, oh yeah, it was Elvis's, so it's worth $40,000. Well, you know, I had to say, well, I'm really sorry. Well, if she could have sold it for that, then she could have brought the cash in, and that I could have.
Yeah.
But that was just, I'll never forget that. Obviously, I haven't. By the way, I should have asked, have any of you been through this? Have any of you owned a home before? Okay, so this is
Good. Yeah.
relevant.
Yeah. Should we allow them to do some
Yeah,
questions?
do you have any questions?
Question about savings. How many years do you think the banks want to see that you've been like regularly saving?
So so there's no, so I'm glad the main seasoning of funds is really just, 60 to 90 days as far as seasoning. That means it's there and established. But we don't look at the overall trend. We just looked at what's the kind of the end result of your savings history. Because it's suddenly you see there's $17,000 in your savings. You're like, well, obviously they've had the ability to save to get to that point, or 40,000 or whatever it happens to be. And so, but then they do ideally want to see that it's been there a couple of months, because if it's not, then suddenly we have to go, okay, well, where did this money come from? And if you're like, yeah.
Then it shouldn't matter, like, when you have your checking account, so like you're kind of putting most of your money in the savings account.
Yeah, a lot of times we have clients with $5 in their checking.
That's okay.
Yeah, because they really just want to shove it all to savings. So the ending balance at their end of the month is like, oh, $5 in checking. Then that's totally fine, because the savings account has the money. Yep, you got it.
The seasoning requirement, it's pretty modest, like Paris said, a couple months or so. But if you come in and the savings has been there for 2 weeks and it's $40,000 or something, then what the lender's thinking is, well, did she just go and borrow that from somebody and she's going to have to pay it back? So that adds to your debt load. That's why it's relevant.
Yeah. So if we see a $40,000 deposit, we might see you proving your bracelet sale.
Yeah, exactly. Yeah, if you can
It's like,
sell
oh,
your
you sold it.
Elvis bracelet, that's
Yeah.
fine.
Yeah. No, good question though. As far as, like we mainly look at that end results, and we want to see that some seasoning in there. Thoughts, questions?
I have a question for my brother-in-law.
Okay.
He is a business owner, and he's trying to explain to me like some additional barriers he will have to buying a home, because he's been living with us for 11 years. So I'm very motivated.
And so you're, yeah,
What would be some additional hurdles? If
you
you're
might want to make him a gift.
self-employed?
It'll save you money over the long.
The bottom of the check is just get out.
Okay, sorry.
Yeah, for self-employment, there are sometimes added layers that we look at, because part of the beauty of being self-employed is that you also can write off a lot of the expense. So your business, looks like it does great. You're like, oh, it's grosses $250,000 a year. Oh, but I have, cost of goods. Oh, all the material costs. Oh, well, then my vehicle, and then and then at the bottom is like taxable income, $25,000. Like, oh, well, that might be nice for you because you don't pay the IRS taxes. But as far as usable income to a bank, man, it's that $25,000. And so that's the only hurdle. So I think a lot of self-employed people feel like there's this hurdle, but I'm like, well, it's because you're telling the IRS that it costs 90% of your revenue is expenses. And it's mainly just a tool to lower the taxable income, which is brilliant because it fits the IRS tax code. But it also now and then erases your ability to be able to get a loan. Yeah, so that's the main hurdle. Any other hurdles really they tend to not be there, unless again, it's like, okay, well, I was a gardener for a year and now I make bird boxes. And so then it's like, well, you have no history in this. So again, it removes that predictability for the bank. We're all about good with self-employment, but again, it's that predictability factor.
In one of my many careers in the past, I was also a real estate broker. And I remember representing potential buyers, and they just completely blew it through the process by, maybe buying a car, or the loan was.
Oh,
Yeah.
So there are certain things that you should not do. before
Yeah.
the loan closes.
That's
Yeah.
a good one.
Yeah.
yes. So that is, I should have said that, pitfalls is, again, we are looking at in the very beginning, we go, okay, great. Here's the debt that we see. Here's the income that we see. Here are the assets that we see. If you materially change that between getting under contract on a house and you wanting to get keys to a house, which is usually a 30-day span or whatever, then the bank is going to look at that again at the end going, okay, nothing changed, right? You didn't quit your job. You didn't use up all your assets and you didn't take out any more debt. And there are clients that are like, again, they come up with come in there with like a $200 car payment. And then the weekend after they get under contract on a house, they're like, well, this is killer deal on a F-350 King Ranch edition that I needed. And I have $1,000 car payment now. So then suddenly it's like, oh, well, you do have a nice truck, but you no longer have a house. So that can happen because the bank will re-review that at the last second to make sure that nothing materially changed. Because again, there's so much risk. So yeah, so I always tell clients, I'm like, okay, from this point on, until you have keys to a house, do not change anything, because it can totally blow up. So I'm super glad you brought that up.
That's a really good question.
It's a question in the chat. Are you there?
Oh, okay.
Ooh-wee.
I can't read it. Can you read
Would
it?
you advise to choose a fixed or adjustable? Ooh,
Oh, good question.
really good question. And so at the moment, there seems to be a upside down world that we're in, and quite often the adjustable rate mortgages on many loan programs is actually worse off than a fixed. But in history, when that's not applicable, so let's say, and I'm going to shoot completely random rates here. Let's say on a 30-year loan that's fixed for 30 years, let's say the rate is 6.5. Well, traditionally or historically, it would be like, okay, well, if it's only fixed for 10 years, maybe it's at 6. Maybe if it's only fixed for 7 years, maybe it's at 5.75. So you can go, well, so I like adjustable rate mortgages when they're priced well, which they're not superbly at the moment. And it logically fits into what you're intending for that house. So you're like, if you're like, this is our first time house, we're going to want a family in about 4 to 5 years from now. There's no way we're living in this house any longer than that. Let's choose a 7-year fixed loan. So it's stretched out over 30 years worth of payments, but the rate is only guaranteed for 7 years. So I want a slightly better rate, and there's no way we're going to be here any longer than 4 to 5 years. So I always advise them, like, go a couple of years longer because you never know. So that's when it makes a bunch of sense to have an adjustable rate mortgage. But if you have no clue, or if this is your forever house, an adjustable rate mortgage is a little bit, it can be riskier because again, it goes adjustable every 6 months after that, after the fixed period.
I'm a real proponent of adjustable rate mortgages. If you look over time, a long period of time, they tend to be a better deal than a 30-year. An exception to that was the last few years, up until maybe a year or two ago, when 30-year mortgages were 3% or
Yeah.
Which
Yep.
That's not realistic. But I thought, well, if I were getting a mortgage today and I could borrow money for 30 years at 3%, I'd do
then you
it.
just do
But
it. Yep.
you're probably not going to see that.
Yep. Okay.
This question says, when making a down payment, where does all the money go to? Does the seller get the down payment minus closing cost items, or does the lender pay the whole cost to the seller and lender receives the down payment? Could you explain that process?
That's a good question.
Yeah. So effectively, it's pooling of funds. It's pooling of the buyer's funds and the lender's funds to equal the purchase price that you agreed on. So $400,000 house, you come up with 50, we'll come up with 350. That goes to the seller. Closing costs and prepaid items. There's a list of items. So you're going to have an appraisal. So somebody going out to make sure it's worth what it is. So part of your closing costs goes there. You have a title and escrow company, like a company that really handles the whole, all the documentation of the transaction from the seller's perspective, buyer's perspective, county, anybody like that. So they have some fees. Your lender has certain costs. You're going to need to take out an insurance policy on the home for against, fire, theft, all those things. There's going to be a portion of the property taxes that need to go to the county. So those are all closing costs that are on top of your down payment. And those essentially get dispersed. So the escrow company effectively goes, okay, well, this company needs this for insurance. Pierce County needs this for excise taxes and property taxes. HomeStreet Bank has their closing costs. So those get dispersed. So hopefully that kind of shows where those funds go.
We hadn't talked about that, but that as a reminder, if you think, okay, I need $10,000 for a down payment, so you're going to need more than that because of these closing costs.
Yeah. So there are fees of obviously getting a mortgage. When it's a slow real estate market, now and then you can negotiate the seller to cover those, and that's allowed. But in a hot market, so we're back to hot at the moment. The sellers are like, no. I have 10 buyers and only 7 of them are asking for this. I'm going to look at the 3 that aren't because I'm going to net the most amount of money. So in a hot market, those are tough to have the ask the seller to pay. But in a slower market or a house that hasn't sold very quickly, a lot of times those can get covered by the seller, which is awesome.
Right.
I'm a first-time home buyer, and approaching a lender is really scary. How do I start? And also, how do I start to potential lenders? What kind of things should I have?
You just go to Pear because he's not scary. Just,
Well, no. So I do recommend going to a local lender where you're buying, because that tends to be a slight path of less resistance, because the realtor that's maybe listing a home goes, oh, I've heard of that company. Oh, yep, I know their reputation. And typically you're going to be working with a real estate agent to help you find a house. And a lot of them will have relationships with a lender. And sometimes you go with where you bank or whatever it happens to be. But a lot of times it's through the realtor that will help do that. But I always recommend local. There's tons of online lenders, but again, random reputations. And it might be a little bit more of a challenge because the seller or the listing agent of that property might be like, I have no clue who that is. I'm uncomfortable with you having an approval letter that says you're all good to go because I don't know who this company is.
So, but specifically so somebody comes to you, what should they ask you or tell you?
Yeah.
I think it's just what we've been talking about.
Yep. So again, I tend to do more of the interviewing because I'm trying to get evidently, obviously you're in front of me wanting to buy a house. So then it's okay, great. So I'll typically draw out that information. And then once that's there, I'm like, okay, shoot with any kind of questions. And then, and I love questions. So I always get scared when people do not ask questions when they're buying a house. So I'm like, well, you're taking on about a $300,000-$400,000 obligation here. I feel like you should ask a lot of questions. So there's a lot of online resources to also like Fannie Mae, which is one like the investors on loans, whatever have. There's good home buyer education classes where they go through 5 hours worth of here's everything about lending and home owning. And those can be informative too. But no, having that sit down conversation or Zoom, whichever one it is I think super duper valuable.
I always get confused about escrow. I'm like, it's the strange thing. It's an account, but is it there forever? I don't. What is escrow? Yeah,
and I don't love the fact that there's 2 different types of escrow. So there's an escrow company. So you've probably heard of Chicago Title or Fidelity or all these big entities. And they're that third neutral party that handles a lot of this transaction. But then on a mortgage, this was known as a escrow impound account, where part of your mortgage payment, so let's say it's $2,500 a month, probably $500 of that mortgage payment per month is 1/12 of your property taxes and 1/12 of your home insurance. Because the bank, especially if you put less than 20% down, has to pay those for you. And so then once a year, they pay your insurance twice a year, they pay your property taxes out of that. So we're kind of gathering it so that you don't suddenly get, every April and October, for example, in this day, you get this like, oh, you owe $3,000 in property taxes. So it's all part of your mortgage payment. So that the bank takes that on as part of the servicing of that loan. And that's an escrow impound account. And so when you go to sell that house, there's typically some money left over that because, we only pay out once a year for insurance, twice. And so then when you go to sell a house, you go, okay, great, I'm selling for 500. I only owe 300. Yes, there's some cost of selling, but the bank just gets paid back that 300. But then we also have like, well, we're also sitting on $2,500 of your money. Here's that money. So you get that money back at that point. And
those accounts are also called reserve accounts, which is more descriptive. Because like Per said, you've got escrow companies that are a third party that handle the disbursement of funds when the transaction closes. And then there are escrow impound accounts. I like to call them reserve accounts.
Yep. So that's their function. And they're always held on these like sort of IOTA accounts, like that are guaranteed not to, the bank is rather scrutinized on the funding and the stability of those funds because they're really not the banks, like they're holding them on their behalf. I do have some clients that's like, after a year or two, they're like, hey, I want to pay my own taxes and insurance. I don't want to be part of that. But then you have to sort of petition for that after you've shown, again, payment history that, yes, you responsibly pay your mortgage every month. And some loans, like, for example, there's an FHA loan, which is a government loan that also allows limited down payment. That one will always have an escrow impound account. You can't waive that one. VA, I think it's mandatory. But anyway, so those, I'm glad you asked. So part of that mortgage payment is not just it's not just the principal and interest of the loan, but also part of it is that it's a portion of your property taxes and your insurance, so they can pay that on your
And back to what Per said about the qualifying ratios. You've got the principal and interest payment on the loan, but part of your mortgage payment is going to be that 1/12 of the estimated property taxes and 1/12 of the homeowner's insurance. And if you're going to get a mortgage, you're required to have homeowner's insurance. So,
so that does be part of the payment that, so you won't have to pay that separate, which is kind of nice. You're like, oh, wait, okay, that portion's taken care of.
It's convenient.
So we're coming up in the hour, so hopefully Rich and her stay here.
Yeah,
sure.
So I just want to thank you so much for
being here. Thank you for having us.
I appreciate all you guys coming here as well. And so let's give them a round of applause.
Thank you guys.
Thanks for coming. We'd be happy to do it again.
Yeah, and also one thing that I really got about it is that there's just so many things just surrounding just home ownership. And I think a class is not understanding escrow and stuff like, and that's the whole process.
Yeah.
And also understanding title, because title is very, very confusing.
Yep.
Yeah, and also maybe even just the home buy process, maybe listening from a real estate broker, what the whole process looks like.
Yeah.
Because I know they're working as well too.
One other, that reminds me of one other thing that we didn't mention is when you should do this. You should go see a lender like Per before you go out and make an offer on a house.
Yeah.
And in fact, if you were to go and engage a realtor to help you find a house, let's say, the realtor would probably tell you that they are not going to work with you until you go get pre-qualified with somebody like Per, because you need to know how much you can afford. So I would do that early.
Yeah, or before you start online dreaming and going on Redfin or Zillow or whatever, and you're like, that one's mine.
And we have cases where people come in and get pre-qualified, and then it's a year or 2 years or something later that they actually buy something. But I would establish a relationship with a good mortgage lender early in the process.
Yeah.
So this is the end of my section. So please stick around and please ask any questions if you have. And add some food.